Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to the program. I'm Chris Boyd. I'm here with Jeff Perry. We are of the AMR team at Wealth Enhancement, and glad to have you joining us for another episode. I wanted to talk about something that's been coming up a little bit more frequently the last few weeks. As Andrew Sorkin, what's his name? Andrew Sorkin. He's got three names anyway.
He does. He's hyphenated. Yep.
Andrew Ross Sorkin. He's been out promoting a book talking about the history of the crash of 1929, and then making some parallels to where we're at. And I think this is causing some concern among some of the people who've been watching these. And actually, you hear the crash of 1929, and if you have any familiarity with that, it's naturally very unsettling to think, could we be headed for something of the magnitude of that? I mean, we used to judge this stock market by the Dow Jones Industrial Average at that time, more so than the S&P 500 we use today. But the point is still the same. It was a drastic decline in values, and it's probably important to remember a little bit about what went into the circumstances of the time. Remember, leading up to the crash of 1929, first off, we didn't have any of the regulatory infrastructure we have today. The consequence of this, it led to the formation of various securities acts and the establishment of the SEC and so forth. So, not to say that regulators always anticipate what can happen or that they're always a few steps ahead of the problems. That's not necessarily the case. But there is some structures. There are some structures in place that were not the case in the 1920s that are very different today. A big part of what led to the decline of 1929 was leverage.
Right.
You can margin an enormous amount of your stock. You could. This is like 10-1.
It was 10-1. I remember that from listening to an interview with Andrew Ross Sorkin. He was talking about that.
So, today you can't do that. There's not that kind of, but imagine if you've got 1/10 of your own money, but you've invested, 10 times that. With the movements, if it's going up, you're feeling brilliant and great. But once it starts to work against you, the magnitude of the loss could be dramatic. And that's led to the people jumping out of buildings and all that kind of stuff we hear about. But this notion that when things started to turn, the excess leverage created a dramatic fall of a much more significant magnitude. That's not allowed today. Right? Now you can have margin, but there's a limit to how much, and it's a limit to how much related to your own money. So you can't even have one time, the amount of margin 10 times. So, keep in mind the amount of leverage embedded in the market is very different now. You can argue there are areas of risk, and we can talk about that as well.
Sure.
Embedded in the market. Brian's been quick to talk about private equity as a private credit, rather, as a source of somewhat opaque. We don't really see, what's the risk there. These are more risk engaged in these bonds. than some others. So, there's potentially areas of risk that could lead to um, a need to sell off. If one part of the market does badly, people look to other parts of their investments to pull money from. So it can have a residual effect if there was a disruption. But again, could it be the magnitude of 1929? I would argue very unlikely, very, very, very
Yeah.
extreme. We've been through extremes. Well, maybe you want to talk about that.
Well, certainly 1929 is getting attention because of the book and all of that. But we've had other periods of time that we've had quote unquote crashes. I was looking up the definition for a crash, because we know a bear market. People know bulls and bears. We know a bear market is defined as 20% reduction from the high. So that's easy to put a definition on. It's just a number.
Yeah.
But when you break that down or attempt to break it down into the crash category, there's no real definition. So I usually turn to Investopedia, and they have a list of things that they have listed under the term crash. So according to Investopedia, 1929, major crash that led to the Great Depression. Dow Jones lost half of its average by mid-November of that year. The next one that they have is the 1987 Black Monday.
Yeah.
Where
that was a huge disruption. What did it drop in that day? By a third in about 5 days, was it something like that?
They only had 22% in one day.
There you go.
And then it kind of lingered on, and
but it had a rapid recovery in that instance within. I want to say it was within 8 months or so, 7-8 months, something like that. It had rebounded. Whereas, like, you think about the 1929, that it took decades.
Yeah,
it was the 1940s really before it started to.
It took a world war, basically, to and all the spending that government did, and so forth, to change that. But so from 1929 to 1987 to 2002 started 2000 to 2002 timeframe that what was commonly referred to as the .com bubble. Crashed, but this was a technology crash. This was a NASDAQ heavy index crash, which certainly had a big effect on people's investments and stuff. But losing nearly 80% of its value, and it took 82 months to recover from the fallout.
It's relevant to think about maybe that moment, that aspect for a moment, that it does take time to recover from disruptions. Most times we've been in a period where over the last 20 years almost, we've probably, if there's a market disruption, it comes racing back. So when was it? So not quite 20 years, but since the declines of 2007, 2008, 2009, we've had this period where the Great Recession, if you will, we've had since that, where if the market goes down, it's back within under 2 years. It seems like it's something close to that, where any disruption is very rapidly erased, and it's not always the case. You mentioned this circumstance that took several years. I think if we look at 2000, 2008, it took years for both of those to have significant recovery. And, in the case of 2000s, just about when you got back from those declines, you started into the declines of 2008. So not really, but it started to slow. So, okay, fine. So sometimes that can take a lot longer. When we look at the early 2000s, the declines of early 2000s, we tend to think of markets having a down year and okay, then people are buyers again. Yeah, it's worth pointing out there are times when we have multiple back-to-back declining years, which we had 3 years in that instance, which is more than normal, but it does happen. And I think part of that we had to, we're in the midst of terror, it disrupted the financial markets, and
That's a good point.
that extended that perhaps longer than it might have otherwise.
Yep.
But you can have prolonged periods of time where equities are languishing. You had to talk about something else before we went on the air.
We had the period of the 1970s, the Jimmy Carter years, the stagflation, the energy crisis. All those things certainly had a significant impact on stocks.
So as we think about a crash, it's probably relevant to talk about, should I be worried as an investor?
I think so. I think it's always relevant. I think it's important to go back and look at some of the lessons of these times. Maybe we don't have to go back all the way back to 1929 or looking at the 1970s, because things were different. We were correct to point out regulatory changes, the willingness of government to intervene in these things. We didn't talk about, but I think it's relevant. Public disclosure is now such a required thing. The way information is shared and consumers, investors,
the speed at which it's available,
have access to it. You talk about 1929. If you're an investor, you have one daily newspaper in the mirror that you're relying on. Now you can turn to live news all the time, different opinions, endless sites and publications and opinions and
commentator on that. Yeah, that's a good point.
So just going back to the 2002 bubble in technology stocks, to me the lesson was that is about over speculation, not doing your homework. Just it almost seemed like back then, if something had the .com on the end of a stock name, people were jumping into it without doing their due diligence, without saying, is this company real in some cases. And also about not being diversified, just jumping in the fear of missing out, right? Technology, all this new thing's going to take over the world. And I guess we can have we do have something to talk about related to technology, something taking over the world right now, with AI.
I think that's part of what fuels this anxiety, right? Is the idea that markets are basically at a relatively high PE, and a lot of that is fueled by the price earnings ratio relative to these artificial intelligence driven companies. A lot of, when we look at some of the biggest names in the S&P 500 today, there is concentration in these names, and the growth expectations from them are significant. We do see them growing at a rapid rate, but there's a lot of assumptions that are going into that for this building out of infrastructure related to artificial intelligence, and that everything will go as planned, So I think, when I hear people talk about this, there's, I think there's an expectation that even within that, the growth rate that's happening is so impressive and incredible that it may be that these PE ratios are not necessarily a good barometer for what we might envision for the potential profitability over time of these companies. The reality, though, is we don't know. Just like in the early 2000s, we don't know who will be the big winners
Right.
to come out of this. So, again, these are things that enter into themes that our team, Brian Regan, has put into place when thinking about how do we invest in a way that will benefit us from artificial intelligence. It's on the one hand, yes, it may be semiconductors and some of the mega cap names, but it can also be picks and shovels, so to speak.
Yeah, utilities is one of the moves that Brian has made that I think is right on that subject.
Yeah, so there's sort of off to the side benefactors consequence of this. So yeah, that's a good point. Let me go back to a couple of things. One is to your point, the regulatory environment is very different than it was. We touched on that a little bit. To most investors that we work with and get probably listed, they're not invested solely in stock.
Right.
And the reason they're not invested entirely in stock is for diversification, to mitigate risk. And diversification and asset allocation, the diversification of asset classes. We don't want to be so concentrated in any one name. We all know that's kind of rule number one, diversify. But diversify in terms of class representation. So that's another way that things are a little different today. People are oftentimes, I think most oftentimes, broadly diversified. We want that to be not just in terms of stock and bonds, but also geographically. We want some foreign exposure, not just U.S. and so on. By having some of these characteristics, we reduce risk. We spread our risk exposure. That's not saying that the market goes down. You'll be exempt. You'll still feel it, but you're not necessarily going to see, this company or maybe sector companies is so disrupted that, I've lost all my wealth. It's temporary in nature. I've got some exposure. I've got broader exposure in a variety of ways. If I've got how much I've got in stock versus bond is going to maybe define the level of volatility and the level of performance I might have in a portfolio. We would say for our clientele that we're also tuned into macroeconomic indicators, and this affects some of the tactical decisions we make with the allocation decisions we make. So that too could be part of how we expect to help our clients navigate such risks. We try to be forward thinking. Doesn't mean we're always going to anticipate, whatever risks may occur. But we do make an effort to try to identify where there's problems and try to position with that in mind. And some of the tactical positioning we do helps us to have a buffer to downside risk, whether it's maybe in terms of what asset classes we include, what alternatives we might have in the mix of investments. We also think it's really important for people to have liquidity. We talk about this a lot, the buckets kind of mindset, but if you're worried about a markets crash, it's a good time to talk about liquidity buffer. How much do you retain as a place to have some excess safety in the process? When things get disrupted, do you have to sell when it's down, or do you have a place to go for cash flow demands? We also, again, this is maybe where you could, if you had a prolonged disruption, you could look to some of your fixed income resources as a place where they would likely be at a profit. If you needed to sell something, you could sell there while you're waiting for things to recover. We think taking time routinely to do some rebalancing of your portfolio is part of how you manage risks. not just leaving things to grow and grow and grow, even though we love when they grow, we don't want to get our allocation out of whack. So we want to rebalance from time to time. And that can also create some opportunities for tax alpha, as they say, but this notion of tax loss harvesting, generating a little bit of benefit from constellation prizes, we might think of it, but it's a little bit of tax benefit when we have something that's out of favor. And when we work with clients, we do stress testing. We look at this in the context of a financial plan. What if markets have a disruption? How does this affect the plan? What if we have less rate of return than we expect? What if we have higher taxes? What if, right? We go through a variety of these kind of things. And that can be helpful for clients to think about. So if you're not getting those kinds of stress tests with your financial advisor, that might be something to talk to them about or talk to someone else about to say, hey, I want to get this kind of planning in my circumstances. Maybe it's time for a portfolio review. Is there excess risk built into your portfolio? Do you have the level of diversification you probably should have, right, to manage some of these risks?
Yeah, that's really something that we see when people come in for a second look on their investment portfolio, or it's a new client, or someone coming in for the first time. Things that we see are exactly what you're talking about. One you didn't touch on, but we do talk about it frequently, is concentration. Maybe an employer stock. So a lot of people are in work for these big companies who are in this AI sector, technology sector, and the big salaries, really a robust industry, it appears, and they're buying stock in these companies, and they come in, and a significant, sometimes all, but a significant part of their future investing portfolio is all on this one company or one sector.
Yeah, it's a big issue. Very common. And a lot of times people live with it because they just don't want the capital gains that they're embedded in these stocks. And they think, well, I'll just wait until I die and get the step up in basis for the next generation.
All right.
We've run into this quite a bit recently, and I would say that if you're in this circumstance, there are techniques to try to help you. And it's worth having a conversation to sort of strategize. How could I mitigate some of this embedded capital gain to try to diversify my risk?
Right. Definitely.
Yeah. So when it comes to this topic, I think it's a little bit scary. I think it might be a little bit sensational. That is, say, 1929. It's not to say we can't have a crash or a decline or a disruption in the market. Inevitably, as Andrew Ross Sorkin said, we will have a crash. I just can't tell you when. Well, we don't know when. We just know inevitably this is the nature of markets, that there will be excesses and there will be disruptions. That's the norm, and that's the way it works. We can, prepare for that by the way we invest and the liquidity we retain in preparation for that as well. So how you invest makes a difference. Just probably worth talking about for a second here is the idea that there's never a perfect solution. If you pick a product that helps to mitigate risk, you give up something else. Maybe you give up some performance. Maybe you have embedded high internal costs. Maybe you have surrender charges that last a long time. There are products that are designed to give you some equity exposure by limited downside risk. These are possibilities both, I'll just say, inside annuities and outside annuities. There are structured products as well. If that's something that you're really drawn to, be aware, oftentimes there's more cost-efficient ways to do things than what you get through a annuity product.
Yeah, through a contract, right?
Yeah, that is prolonged and keeps you kind of captive for 5 to 10, even pushing 12 years sometimes.
Yeah. Sometimes those products are sold to people. Often those products are sold to people who are looking for a specific solution. Might be income, might be, market protection. And I don't think enough time is spent by the people buying those products to ask, what are we giving up here? What is the downside? Because you're correct. In life, there's very few, if any, free lunches. To get something, you're giving something. So learn the downside about whatever you're doing too.
Yeah, and think in terms of, it's not an all or nothing kind of solution too. I think in investing, that's one of the continuing lessons is, you don't have to be all in or all out or, whatever approach you take. It's probably virtuous to have a range of considerations.
Absolutely. Even, taking all of your money and putting it in a FDIC institution with, thinking I don't want any risk. I don't want to suffer through any of this. You're still taking risk.
It's just different risk. You're taking inflation risk. You're taking, the interest rate risk, and there's a variety of risks that you're taking in that process. So even the most conservative person is exposed to risk. It's just which risks, to what extent.
Yep.
So, all right, with that, that's probably a good conversation. Thanks, Jeff, for indulging me. This was something that I wanted to spend a little time on because I feel like it's been coming up, and I hope it's helpful to our listeners. And until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.